Hey there, friend. What if that three-digit number on your credit report is quietly shaping decisions in your life far beyond just borrowing money? From the apartment you land to the insurance bill landing in your mailbox, it's pulling strings most people never even notice. I'm your buddy here at Money Mechanics, and today we're diving into the real mechanics of how credit scores work in 2026. The surprising layers that actually move the needle for everyday wallets like yours and mine. Let's start with something that trips up a lot of folks right away. There's no single magic credit score. You've got different models across the bureaus, and lenders choose whichever version suits their needs. FICO for most mortgages, Vantage Score for others that look at trended patterns over months instead of a snapshot. Imagine split-screen graphics on your screen showing your reports side by side, numbers shifting by 50 points or more depending on who's looking. This plays out in real life when one lender approves you at a great rate while another hesitates. The quietly astonishing part? It's all based on the exact same data interpreted just a little differently. For you, that means pulling your free annual reports from all three bureaus gives you the full picture and helps you spot where to focus. Simple knowledge that keeps you ahead instead of guessing. Here's another twist most never see coming. Credit utilization isn't just your total balances versus all your limits. It drills down per card too. Max out even one while the rest sit low, and it can sting your score harder than expected. Picture a clean animation where individual card meters glow red, then cool to green as you spread payments strategically. In real life, this shows up as higher interest on your next car loan or denied approvals that feel random. Keeping each card under 30%, ideally closer to 10, delivers fast, visible improvements. That's the empowering bit. Small monthly tweaks give you quick control over a number that affects way more than you think. Now shift with me to the length of your credit history, because time on the books carries serious weight. Closing old cards or opening too many new ones at once can shorten your average account age and create a temporary dip. Watch a timeline graphic stretch across the screen, account icons fading or popping in as the average age adjusts. People who tidy up their wallet sometimes watch their score slide right when they need it steady. Real-world impact hits when you're trying to refinance or buy a home. But here's why this matters for you. Letting those older accounts breathe, even with a small annual purchase, builds long-term strength without extra work, turning patience into actual financial leverage. And you don't have to build everything from scratch alone. Becoming an authorized user on a trusted family member's solid account can layer positive payment history straight onto your report. Cut to a warm family scene at the kitchen table, a card handed over, then a score graph climbing steadily. This has quietly helped partners, young adults, and newcomers get traction faster than starting solo. For you, it means tapping into reliable networks feels supportive, not risky, and accelerates the kind of progress that opens real doors. One of the coolest shifts happening right now involves alternative data stepping into the mix. On-time rent, utilities, and phone payments can now get reported through simple services and show up positively in newer models. Envision quick, vibrant clips of an app notification confirming a rent payment, followed by green checkmarks updating your file. This is huge for the millions who used to be credit invisible. No traditional loans, but still responsible payers. It changes lives by helping them qualify for better rates sooner. Super useful because your biggest monthly bill might already be working for you if you opt in, turning routine responsibility into score-building gold. Speaking of everyday ripple effects, your score sneaks into places you wouldn't expect. Insurers run credit-based versions to price auto, home, or renters policies, so a stronger number often means noticeably lower premiums, sometimes hundreds saved a year. Landlords check it for apartment approvals and deposit amounts, while utilities look at it before waiving big upfront fees. Picture cinematic cuts. A driver smiling at a lower insurance quote, a couple high-fiving after apartment approval, lights turning on in a new home without extra deposits. These moments hit real families and their monthly budgets. The best part for you? Improving your score isn't just about loans anymore. It smooths out costs across daily life and puts more money back where it belongs. One last quick layer, hard inquiries from applications show up and can nudge your score for a few months, but soft checks you run yourself or pre-approvals don't touch it, and payments only count as late after 30 full days. It's all designed with those hidden mechanics that reward consistency. Fascinating money fact of the day. The roots of credit reporting go all the way back to the 1800s, when merchants literally passed around physical ledger books to warn each other about risky customers. Today's digital bureaus handle billions of data points on over 200 million Americans, but the core idea of trust and patterns hasn't changed. Taking a step back, that whole alternative data piece really stands out. It's turning ordinary bills into building blocks for your future options. What's one credit habit you're thinking about tweaking after hearing this? Or maybe a surprise you've run into with your own score? Drop it in the comments because I genuinely love hearing how this lands for you. We'll keep uncovering more money mechanics that make these systems work for you instead of the other way around. Talk soon. Take care out there.